Welcome to Houston Home Talk, featuring all things real estate in the Houston area. We'll interview real estate professionals, local business owners, and special guests from right here in the Houston community. This is where you get the inside scoop about what's new in real estate, new community openings, and business openings, and much more. The Houston Home Talk Show starts right now.
Welcome, guys. This is James J back with another episode, Houston Home Talk. Today, we are going to talk about escrowing your taxes and your insurance. So this topic is important because there are a lot of people that like to pay their taxes and insurance by themselves. There are other people who don't want any part of paying their taxes and insurance by themselves at the end of the year, and therefore they select to have an escrow account. So escrow, guys, is simply taking your taxes and your insurance. We typically divide that number out, whatever that number is, divided by 12, which is a year. And then you pay a small portion of that number every single month. So for example, if your insurance is $144 a year, which we know that's not the case, but for easy math purposes, you're going to pay $12 a month. $12 a month. $12 a month. You do that every year, unless you change your coverage, change companies, and the coverage goes either up or down. The bottom line is we're just going to take a portion of your taxes and insurance and pay it every month, instead of you getting one tax bill at the end of the year or one insurance bill during the year and having to pay the whole thing at once. So that is simply what an escrow account is. Now, should you pay it separately or should you not? Well, the answer really depends on the type of mortgage also and the equity that you have in it. And it also boils down to the risk the lenders are prepared to take. So if you are using an FHA loan or some type of government loan, typically, so we're talking VA, FHA, you do not have an option of not having an escrow account. Okay, so they're going to make it mandatory that you have an escrow account. If you are using a conventional loan and you choose to put down 20%, then you do not have to have an escrow account. In addition, the risk that your lender incurs on the loan amount, again, you put down more money on a conventional loan, there's less risk. If you put down more money on any loan, for that matter, there's less risk to the lender. But the conventional loan is the only one where you can put down 20% or more and decide not to have the escrow account. Now, if borrowers have little savings after their down payment, may be unable to put away sufficient money to pay their property taxes monthly. So lenders are concerned about what happens in the unexpected, unforeseen expense happens. So what am I referring to? So lenders are all about risk. So if you're having a relatively difficult time coming up with down payment money or any other closing cost, and you're always needing help as it relates to those two costs, lenders are going to be a little more leery of allowing you to have a non-escrowed account. Again, if you're using FHA, VA, you don't have a choice. But if it's a conventional loan and there's not a whole lot of money in your bank account and you need assistance with getting down payment money, closing costs, and so forth, the lenders may be in a situation where they decide that you need to have an escrow account, that you may need to have that almost security of paying a portion of it each month versus you getting one bill for taxes and insurance and being obligated to pay that bill during the year all at one time. So FHA loans, again, they require mortgage payments to include property taxes, mortgage insurance, and property insurance. The mortgage insurance and the property insurance is completely separate, guys. It's not the same thing. We're going to talk about mortgage insurance on another episode, but mortgage insurance and property insurance are not the same thing. Now, the FHA requirements are in part due to the fact that many of the buyers put down as little as 3.5% and may have less than ideal credit. So that mortgage insurance is there to protect the lender. It is not for you. It's to protect the lender. With conventional or Fannie Mae type loans, each individual lender has its own escrow requirements, mostly based on down payment amount and credit profile. Now, while some lenders may be likely to waive escrow requirements for someone putting down 35 to 40%, they would be unlikely to do so for a borrower with 15 to 20% as a down payment. Even with a large down payment, the lender may charge a premium in the form of a rate increase to waive escrow and to cover the added risk. So, what that means is that when you waive escrow account, when you waive your escrow, you decide, I don't want to pay taxes and insurance monthly as part of my monthly mortgage payment. I do not want to do that. The lender looks at that as a little bit of extra risk. Why? Well, if you get a tax bill once a year and you can't pay it, you can lose your house. And the lenders don't want your house. Lenders hate REO properties. They do not want to foreclose on a house. Contrary to what people may think, or some people may think, lenders do not want homes. They want to lend money and they want to collect interest. They do not want a home back. So when you waive escrows, it is a little bit more of a risk for the lender. So what they do typically is your interest rate may bump up slightly. It's a very, very minimal bump up, but nonetheless, it's still an increase in your rate when you waive escrows. There may be some other ways of foregoing these costs. Talk to a reputable lender and they can assist you with answering questions as it relates to waiving escrows, what the extra costs may be, and if there's a way for you to waive escrows without incurring any additional fees. So that's going to be something that you want to discuss with your lender. Now, for the borrower, there's also a positive take. In my opinion, it's better to just pay it every month and not think about it. Let the lender do the work. So you pay your portion every month, every month, every month. When the bill comes due for your taxes, your lender will pay your taxes with the escrow money that you have in there. When it's time to pay your homeowner's insurance, they'll get the bill, they take what you put in escrow, and they pay that bill in full for the year. It's just a much more efficient way, in my opinion. But I do know there are people who get large bonuses throughout the year, and sometimes they just prefer to have a much lower monthly payment where they're just paying their principal and interest, and then they'll just pay their taxes and insurance once they get a bonus. So everyone's situation is a little different, but overall, I recommend people to pay the taxes and insurance monthly in the form of an escrow account. So if you guys have any questions as it relates to escrows, reach out to us. Head on over to HoustonHometalk.com, and I will catch you guys on the next episode of Houston Home Talk. Peace.